Mr. Phanatics, we're ready for you now.
Good morning, everyone. Welcome back. I'm Keith Daly, principal here at Travillian, Banking and Fintech. We're calling this panel Technology Fanatics, since we're here in Philadelphia, Phillies country. Let's go Dodgers. Sorry, I'm a bitter Mets fan. Any Mets fans in the house? Couple? Yeah, there we go. We'll meet at the bar later and talk about that horrible season we just had. And we also have a couple Yankee fans on stage. Sorry about that, but we'll move on.
Only thing worse than being a Yankees fan is being a Mets fan.
That's very, very true. Very, very true. Ouch. But back to banking. So 96% of community banks still rely on outdated tech vendors. Are community banks finally ready to stop being technology followers, or are they still in the wait-and-see phase? We have an all-star panel here. I'd like to introduce our panel, starting with Nathaniel.
Hi, everybody. Nathaniel Harley, founder of MANTL and current Chief Revenue Officer of Alkami.
Ryan Hildebrand, Chief Information Officer at Bankwell Bank, a $3.2 billion bank based in Connecticut.
And Jeremy Mandell, I'm a partner at Morrison and Foerster. I co-chair our financial services practice, and I'm bringing the DC regulatory perspective to this august panel.
Fantastic. Thanks for joining us, fellas. So we're going to start off with artificial intelligence, AI. It's been brought up already multiple times in this conference this morning. And here are a few fun facts from the Alkami research team. 65% of digital banking Americans say in 5 years, AI will have dramatically changed how they do business with their bank or credit union. 46% are okay with AI processing their financial data if it gives them a better banking experience, including 57% of millennials. So I'll start with you, Ryan. You've written that banks should stop outsourcing innovation, but with AI, most community banks are starting from ground zero. What's the low-risk, high-reward learning pilot program you would recommend to a CEO who has never implemented AI?
So for us, we really rolled out Microsoft Copilot, not just the free version that comes somewhat within some of the Microsoft ecosystem. We actually invested in the enterprise solution and rolled it out to everyone across the bank. Obviously, there's a lot of governance that needs to get done on that, a lot of data security things that need to be rolled out. But really, we just really started to put together a pilot group within the bank itself. We identified people that were really excited about using AI, not just using it on their personal devices, really just thinking about how they can incorporate it day to day. And so we rolled out a pilot group with someone that runs FP&A, the head of marketing, some folks in operations, obviously on the risk side, which we see a huge opportunity there. And so we really did a pilot group first, and we meet at least once a week to talk about new use cases that people had developed and really be able to really focus on what's happening, what are some of the things that they're running into. We learned a lot through that process, and then we're able to, over the course of the summer, roll it out to everyone in the bank at this point. It wasn't worth waiting. It was really just an opportunity for us to just push forward on getting it rolled out at this point.
Thanks for that. Jeremy, from a regulatory perspective, this is on everybody's mind. What does explainable AI mean to the regulators? When they walk through that door, a lot of the times regulators are behind the curve. So from your expertise, how can you guide community banks through that process with AI?
Yeah. So I think it's a great question. And I agree with your kind of assessment that a lot of times when a regulator or when an exam team is trying to learn how banks are deploying AI, how banks are leveraging AI, they are learning along with their exam process. And so that kind of gets to the core of what is explainable AI. With explainable AI, or explaining your AI, right, is the ability to say the purpose of the AI, understanding the inputs that are used, the outputs and the suitability of those outputs, and the business justification of the use of that AI. So really, I think that if you can articulate all of those things and document it in a way that is not only understandable for management, also for the regulators and the exam teams, and ultimately to the extent applicable to your customers, where it's kind of shown to them, where it's frontward facing.
Yeah. And Nathaniel, for fintech like MANTL, serving the community bank space, the credit union space, how are you thinking about AI for your customers and the benefits for your customers?
Yeah, so I think AI has the ability to right now primarily do two things. Number one, drive operational efficiency across the organization, and then two, really help the community institutions further deepen their relationships, right? And so as we sort of think about, how do you layer in AI into technology products, we're very focused on high context agents, which means, really utilizing the existing data that the bank or, in some cases credit unions have at their disposal, and then using that to create automated workflows around things like fraud or manual review or, areas of the business that require today a lot of human touch. I will say that, to the point made earlier, a human in the loop is still really important. Like, it's not a solve all your problems yet, and you definitely need to have a banker in the loop to make sure that whatever result or sort of thing it's spitting out is correct. So that's really important. And then on sort of the other side of the spectrum, as we think about deepening relationships, it can really make the banker more intelligent, right? You have someone sitting in front of you, you have all this data that might be in different systems. How do you aggregate that data in a way and then serve the banker information so that they know, all right, here's the next best product that they should, offer to their customer or business that's sitting in front of them. I think the sort of last point, there's a lot of talk around culture and team, and Ryan just sort of spoke about the top-down initiative at the bank to sort of say, all right, maybe it's early, but let's just go for it and roll out Microsoft Copilot. I think that's honestly where it has to start. And we're probably too early to really pick a model winner. And so, in my mind, lowering the barrier to entry and making it a top-down priority at your institution and almost saying every person at your bank has to be using it is really important. I think Citi just the other day, for example, launched an initiative where they now require 175,000 of their employees to actually go through AI training and start to learn these tools. And it has to start at the top. And from an Alkami and MANTL perspective, every single person has a goal around AI, right? And sort of is given the tools, and our mission is to really lower the barrier of entry to make it as easy to use as possible. But in my mind, it does have to start at the top, because you'll get a lot of benefit from your employees. And it's not necessarily the goal to replace them today, but really augment what they're doing, allow you to continue to grow with the same headcount that you have, and as I said, get more efficient and hopefully find bigger areas of growth.
Well, thanks, Nathaniel. This is a follow-up question for the panel here. Only 21% of banks actually measure ROI on technology projects. How do you prove AI is worth the investment? I'll start with you, Ryan. You are in a bank.
Yeah, I think we've heard this probably the last couple of years at every conference. It starts with the data. So if you haven't invested in data, it's time to really invest in that and lean into that. And that's really important. If you can't track something, then you're not going to be able to figure out what that ROI is. It's still shocking that it's only 20% at this point. So there's a lot of work that needs to be done, and a lot of the work needs to be done pretty quickly here to be able to catch up with the speed of things. But every project we do, we really put together kind of a business plan around it, what the ROI we think it's going to be, and then we obviously need to track it afterwards. I think the problem is when you don't track these things, then you're just left in the dark on it. And I think that's one of the big issues that we see for sure is really not understanding what the value you're actually getting. It may be cool, but if you're not getting value from it, then you're wasting time as well as money.
That's great. I don't know if Jeremy, you wanted to follow.
No, I mean, maybe just to bring a kind of a regulatory perspective to that. makes a lot of sense. And I think I appreciate what the earlier panel said about a more accommodative posture from the federal banking agencies. And I think if you think about it from a cost side, I think there is, and compliance costs perspective, I think there is a message that's being sent from the agencies that use of AI and the compliance structure around the use of AI is risk dependent. And so, depending on the complexity of the model, depending on the criticality of the model, where the model sits in your business, that you're not expected to have the same compliance infrastructure around each of those models. So for example, earlier, I think this week or end of last week, the OCC acknowledged that for community bankers that there isn't, for example, an annual validation expectation for all models. It should be risk-based. And so I think that from a cost perspective, there is a more accommodative perspective in DC and among the banking agencies.
That's great. And Nathaniel, I know you have to deal with community banks on a daily basis and probably prove the ROI. And do you have any suggestions for community banks out there?
Yeah, look, I think Ryan sort of hit it on the head, right? Like you have to start with an initial thesis on this is the value that we're going to get, and then you ultimately need to be able to track that. I think what's sometimes hard about it is, what are you tracking? And so let's just use like the banker example. Maybe it's time saved. That's sort of, how do you associate that with the number of dollars, and does that ultimately lead to a reduction in headcount? Is that what you want to do from an organizational perspective? But I think it all comes down to really sort of having a hypothesis, setting, putting a stake in the ground, saying, we're going to lower costs by 20%, and then tracking that, over the course of the project to make sure that, you're either delivering on that or not, and that then ultimately allows you to sort of pivot or continue to invest more or less based on the results that you're seeing.
That's great. And bringing this back around to talent, Travillian's expertise. I ask this of all experts in the industry when I'm on the phone with them or a Zoom call. What talent do you think community banks will need to think about for AI over the next few years? I've seen some chief AI officers out there, head of AI. In my humble opinion, I think every bank is going to need somebody who understands it. They're not going to be able to, bring in MIT engineers to build it. But what are your thoughts on the talent at community banks in regards to artificial intelligence? I'll start with Ryan.
Oh, sure. I think really, what we look at is people that have really a curiosity around understanding these things. I mean, things are changing so fast. I mean, every week, every few days even, there's things that are coming out that it's really hard to stay on track. So that curiosity around what's happening is important. Really having a mindset around product is the other thing that we're really focused on. So, looking at roles like product manager, someone that really is a kind of a mini CEO of a business or a product line. That's really important. So they have backgrounds in maybe business, marketing, engineering. We've got folks that have mathematics degrees that are really focused around product stuff. So it's really understanding kind of the whole capacity of something. Obviously, being risk-minded is very important because everything in banking has got a risk tenet to it. So that's where we're really focused on, is making sure we have really solid product managers that understand this, because everything right now is just moving quickly. It's all about learning of these products as they move forward.
And maybe just to sort of layer onto that, like the way I sort of think about it is how do you institutionalize this across the organization? And in my mind, it has to start in hiring. So how do you screen for, let's say, the curiosity that you just talked about in the hiring process? Just to give an example, maybe 12 months ago, we'd be interviewing engineers, and it would be viewed as a bad thing to pull up, ChatGPT or Cursor or one of these, programs in a coding interview. That shouldn't be viewed as a bad thing. Everyone should be expected to be using AI to be more efficient and better at their jobs. So including it as a step in the hiring process is really, really important to sort of weed out, who's leaning in, who's not. And then I think from an existing employee perspective, embedding it in your performance management and making sure that it is, part of your performance management cycle. You have goals around it. And then you also have the enablement to help train your employees. And I think it's telling, right? The ones who lean into it are probably the ones that you want to be around, and the ones that shy away are probably the ones you ultimately want to move on from.
Yeah, and I think, Jeremy, from a risk and compliance perspective, having a chief risk officer who can, so somebody's going to have to explain what
Exactly.
the bank is doing to the regulators. You're going to need to have somebody in that seat
and not
explain
limited
that.
and not limited to the regulators, right? So
Yeah.
the curiosity is critical, but then having someone within the organization or some function within the organization that can explain to management, explain to the board how these models are being used, how the bank is leveraging them, how that fits into the bank's overall risk appetite and strategic plan. So it really is that translatability of the way that you are deploying and leveraging AI and generally and models specifically. So,
Oh, fantastic. And that kind of segues into our next topic. It's fighting fraud in real time. And with AI technology out there, fraud, I know everybody in this room is probably getting phone calls, and it's getting really, really crazy out there. But fraud losses hit $10 billion last year. Fintechs and financial institutions spend $21 billion every year on fraud prevention and detection, yet nearly 60% reported an increase in attacks last year. Let's jump into this critical discussion. I'll start with you, Jeremy. If a community bank gets breached because they're underinvested in fraud prevention, what is their legal exposure, and are boards getting this message?
yeah, it's a critical question, and of course, as the folks in this room know, the standards that apply to community banks are generally the same standards that apply to banks with significantly greater resources to invest in fighting fraud, including in real time. Generally, GLBA, generally the interagency guidelines on information security, PCI to the PCI data security standards to the extent we're talking about card-based data. All of that forms the structure, right, that you're considering as it relates to keeping data secure and fighting fraud. And then as you drill down into the way that data is used, you have all of the frameworks, including in the consumer context, including in the business and commercial context, with unauthorized transactions in Reg E and the EFTA, the Uniform Commercial Code in Article 4A on what is a commercially reasonable security standard. And banks have to consider all of these frameworks when determining how to fight fraud and how to invest in fraud prevention. And then beyond the regulatory context, a lot of your transactional your transactions, your vendor agreements, for example, will allocate responsibility for breach and for underinvestment in fraud prevention and the like. So really, it's a 360-degree view on what it means to fight fraud and how to secure data. It is a challenge in this evolving fraud landscape.
No, thanks, Jeremy. And Nathaniel, every bank is looking to reduce the time it takes to open new accounts. At MANTL, how do you find that right balance between fraud prevention and customer experience?
Yeah, so I think it's a bit of a fallacy that you can't have an amazing customer experience while also being in compliant and fighting fraud, right? You have to be in compliance, you have to fight fraud, but that does not mean that you can't have an amazing customer experience. So the way we sort of think about it is, number one, you got to have the tools in place that allow you to have access to data sources and things like that that are sort of running in the background at every step of the process to make sure that, as someone goes through, let's say, an account opening application, you're ensuring that they are who they say they are, and then you're ultimately validating that. That's really important. Number two, you have a system that's flexible and can sort of adapt to what you learn about the customer, whether it's an individual or a business, as you get more information. We like to say make the punishment fit the crime. So, you have a cash-intensive business with an ATM on site, like, great, that's when you should ask for an ATM lease. You shouldn't ask for that for every single business that signs up. And then, I think there's a bit of a gap in understanding of the regulations and what the BSA actually requires. For example, non-documentary based verification is 100% accepted, but the number of institutions we walk into and say, we must collect a driver's license, the impact of that is you actually will degrade the customer experience. You would see, for example, let's say a 30% increase in drop-off in an application flow if you wanted to take a picture of the driver's license in the main flow, but a very negligible effect in terms of reduction of fraud. And so instead of adding all this friction up front, because it's not required to actually collect a physical copy of the driver's license, use that as a step up for the customers that actually fall in the higher risk bucket. And then you can also embed tools like Vouched or whatever that sort of take pictures of these driver's license, take a selfie, and then really automate the sort of human in the loop process to sort of continue to save time and automation. And then I would say lastly, going back to the tool perspective, we work with a bunch of orchestration systems like Alloy and Tactile and a number of those different companies that allow you to really ingest and work with these underlying data sources very quickly and then configure the rule set around them. So as you're seeing patterns, account takeover, whatever it might be, you can tweak the knobs real time to stop that fraud in its track. And so you got to have the right set of tools, but that doesn't mean you can't have an amazing customer experience and also an amazing experience for your employees.
That's great. And then Ryan, at Bankwell, you've actually implemented real-time detection. What's the difference between what a community bank can afford versus what, say, a JP Morgan deploys?
I think most of the semi-modern, transaction monitoring systems have these capabilities. I mean, I don't think we're not at a place where it's really hard. I think it's really making sure you have to fine-tune what those transaction monitoring systems are doing. We're honestly seeing the biggest spike that's coming from, the classic stuff, social engineering and checks. Like that's the biggest things that are happening right now. I think we've got a really solid baseline of really understanding our transactions day to day. I think making sure that we can set those settings to the right place so that we don't have to have our team spending so much. Using AI to be able to really service up those alerts and be able to respond to those suspicious activities quickly, I think is probably the biggest lever up, I guess, in the last year for us. But it's really old school stuff still at this point. And as much as reviewing checks and using some of the new capabilities that are out there, it still becomes hard. It's a cat and mouse game for sure. That's what we're seeing.
Cat and mouse game.
Yes.
I feel like the bad actors out there are always one step ahead or trying to get one step ahead. But no, thank you for that. We're going to move on to the next segment, which is niche segmentation for community banks. And Nathaniel, MANTL actually worked with Ryan at Bankwell for Bankwell Direct, which has led to, I think in 2 years, $195 million in deposits. A consumer can open up an account in less than 4 minutes, and over 86% of online applications require no manual intervention. Community banks and credit unions have struggled over the years to keep up with that type of technology. How is MANTL enabling them to modernize their operations and partner with banks such as Bankwell?
Yeah, well, I think Ryan and Bankwell is a great example of what a community bank can do from an innovation perspective and not necessarily, be held back by the legacy brand and sort of cultural inertia that tends to happen. Look, at the end of the day, you look at the data, right? 9% of checking accounts, I think last year, were opened at community institutions. 44% were opened through Chime and some of the digital players, right? So the competition is real, and consumers, especially the younger ones, are moving away from community institutions. So in order to compete, you have to have a solution that is like a Chime solution, right? You have to level the playing field so when someone interacts with you online, they walk into the branch, they feel like they're working with a modern organization, because otherwise they're going to walk out the door, they're going to abandon the application, and they're never going to do business with you at the end of the day. So it's really important to work with technology partners that are providing solutions that allow you to compete with the Chases and the Chimes of the world. I also think bridging the different channels is super important, right? So obviously a lot of community banks are very relationship-driven, branch-driven organizations at the end of the day. And so, most of the time having a digital acquisition strategy might not be part of the wheelhouse. So, thinking about your roadmap to, all right, how do we maybe create a digital acquisition strategy? Is that correct for our institution? Do we want to lean more into the human-led strategy, which is relationship managers or bankers or whatnot, but ultimately bringing parity to those two channels, and then giving yourself a tool set that allows you, like Bankwell, to turn on the solution and go raise a bunch of deposits, for example, when you need to go do it. I would say the last point I'd make is continuous innovation, right? And having a solution that's able to sort of keep up with the newest technology that's come out. A great example is Plaid. Plaid just launched a brand new product that they call Plaid Layer. Essentially what that allows you to do, so Plaid has essentially touched 50% of consumers across the US. So someone enters their first name, last name, email, and phone number. In the background, Plaid is able to check you against their database and automatically verify you are who you say you are, pull all your information like address and social, and then also all of the bank accounts that you have funded. What happens then? Now you're able to open that account in under a minute. So when you think about that compared to what Chime or some of these other institutions, that's what we mean by level the playing field and lowering the friction so that you have this amazing customer experience that ultimately allows you to continue to grow your institution.
That's great. And Ryan, at Bankwell, what has that unlocked for your?
Well, I mean, I think it's super helpful to have speed and really a good customer experience. We're finally getting to that point, so thank you for building a good solution. But I think it starts to extend beyond that at this point. It's just table stakes. You either have technology or you don't. And I think soon enough, technology is going to matter less because everyone's going to have the same utility in many ways. And so I think we're getting to that point. I'm not sure what the digital account opening numbers are these days for most institutions, but it starts to become more of a business problem. So, what product do you want to offer? What segments do you want to go after? How do you want to market it? These types of things versus it being, okay, we need technology. So, there's still this thought of like, okay, we got to get it stood up and then deposits come. Well, you actually have to have a business plan behind it. And so I think that's probably the piece that we're just now getting to is really understanding kind of where do you want to go with these tools. And it's really the business that matters.
Yeah. And Jeremy, risk and compliance always comes up. What are 3 non-negotiable questions CEOs have to ask fintechs before partnering with them?
Yeah, so 3 non-negotiables. It's hard to whittle down, right? Because in part this is life cycle risk management when it comes to how you work with the vendors with whom you contract. But from my perspective and in our practice, if I had to choose 3 non-negotiables, right? One would be alignment on compliance responsibilities, right? Banks are never going to be able to avoid accountability for compliance obligations, but understanding who within the partnership is responsible for performing these compliance obligations, I think would be clear understanding of that, and alignment on that issue is one of the non-negotiables. A second would be clear understanding on data security and data protection issues. We've seen in the course of our the clients that we represent in the negotiations that community banks have had with their vendors, with their fintech partners, that issue is often one of the most contentious issues, but also one that is critical to banks. And the third would be, I think, non-negotiable would be financial condition and exit strategy for banks as they enter into these partnerships, right? Understanding that you will remain accountable for the relationship and the way that the fintech is leveraged for your business solutions. And so understanding the financial condition of your partner and also understanding what it means to break up with that partner and what impact that will have on the bank. Of course, we've all seen very publicly that sometimes those breakups go bad. So really planning for that exit, I think, is one of the key non-negotiables for banks that are looking to partner in this space.
And I think regulators are even looking, 3 levels down now, right? Because MANTL has partners, so looking at the viability of those companies below even a MANTL or an Alkami. That was great. Moving on to rapid fire questions. And Nathaniel, one technology investment that pays for itself within 18 months. Doesn't have to be 18 months.
Obviously, I would say account opening. But okay, I think it's a bit broader. Yeah, exactly. I think it's a bit broader than that, right? And you know, when we go and when I have conversations with a lot of bank CEOs, and you know, I think all of them are sort of asking themselves the same question, right? Like, how do we be amazing at relationship banking, which is our key differentiator in the digital world as we were in the analog world, right? And I think a lot are struggling to do that today with the existing technology because it's hard to onboard and engage and ultimately grow your customer base. And so really what we think that the future is, and really what the next phase of relationship banking looks like, is what we call anticipatory banking, where you can ultimately aggregate all of these disparate systems and disparate data under one roof, and then anticipate the needs of your customers, and also make your bankers way smarter and better at their job. And the way that you deliver on that is through what we call the digital sales and service platform, which is ultimately unifying the onboarding and account opening experience with the digital banking experience and the data and marketing experience to ultimately deliver real-time insights to the end customer and the bankers so that they can, you know, ultimately deepen the relationship, deepen the share of wallet, you know, have the products that they want to sign up for. So, you know, I think what sort of stems from that is having a broader vision of where you want to take the institution. Obviously, account opening is a nice tip of the spear and good place to start. But you know, really, I think it's ultimately broader than that when you think about your tech stack and think about how you ultimately want to consolidate your vendors under one roof.
That's great. And Ryan, first AI investment that shows results in 90 to 120 days.
I would say it's actually looking at your existing stack. It's nothing to do with AI. You got to make room for, you know, all the AI things you want to do, or flip switches on at a lot of your vendors with AI. It's actually figuring out what you're paying for and you're actually not using, or you had like a bad implementation and you have things that aren't switched on properly. Like, actually just look at what you have now before you embark on more things, because you know we found a lot of things that we were paying for and we weren't actually using, and so I think that's probably the biggest bang for your buck right now, is just understanding what you're paying for and what you're using.
That's great. And Jeremy, biggest legal mistake you see community banks making with fintech partnerships?
Yeah, I mean, I think the good news is that that we've been through a couple of cycles now, whether it's from an enforcement action perspective and just kind of we're further along the learning curve, right? So the perspective that both fintechs and community banks bring to these partnerships, I think is somewhat more advanced. And so you're not at the point where we were, call it 18 months ago, 2 years ago, maybe even 3 years ago now, where you're educating prospective fintech partners on what offering a regulated product or service, what being a regulated entity means, and what the expectations on that regulated entity are. So I think we've moved along that learning curve, and so it's not as much forced education, which makes things easier. That doesn't mean that there still aren't mistakes, right? And I think I would go back to understanding what the exit is, and if you don't appropriately plan for the exit, including as it relates to you can imagine in the transaction context, including as it relates to trailing transactions, including as it relates to data portability and required reports, and the way that you would support an offboarding of a fintech partner so that the bank can either elect a new partner or pivot from a strategic perspective. I think really planning for that is one of the kind of key remaining mistakes that we continue to see.
That's great. No, thanks, Jeremy. Yeah, as we wrap things up, I love this question. It really boils it down. For a CEO walking out of the Union League today, what's one technology decision they should make before end of year? I'll start with you, Ryan.
One decision, probably spend more money. Honestly, I think we have to invest more. You know, banks are technology companies more and more. I mean, they're technology buyers, and it's more and more, you know, a technology game. At the same time, it still is a people business, but I think you have to continue to invest in technology to support your people. And I think that's just something we're going to have to move forward. And I think it absolutely will pay for itself, but you have to make sure you're making the right bets.
That's good. And Jeremy, one decision they can make.
Yeah, if you had asked me 12 months ago, I would have talked a little bit more about open banking and 1033. I think now the focus is around real-time fraud. I think that you know, that the risks related to being a bank that is the face of a perpetrated fraud are significant enough that that the kinds of tools that we're talking about, the kinds of even AI-driven tools that can help to fight fraud in real time, I think are where you'll get the most lift in the near term.
Yeah, because fraud with community banks has a much larger impact. JP Morgan, it's just kind of a write-off, right?
Yeah.
And we'll end it with Nathaniel. One decision they can make: call MANTL.
Yeah, buy MANTL. But no, look, I think you obviously have to have best-in-class solutions across the onboarding, account opening, and digital banking sphere, and that includes, you know, fraud and, you know, data and marketing. But, you know, to me, it's almost take a step back, right? Like, you have to have a 3 to 5 year vision and strategy and understanding what your goals are. You have to understand what do you want your culture and people to look like in order to go hit those goals, and then what is the technology you need to go support them, right? And then that's how you sort of figure out your roadmap. So to me, that's the most important thing that then allows you to sort of make, you know, intelligent decisions on sort of where you land and what you do next.
Great. And to wrap it up, I guess add one more rapid fire question. Who do you think is going to win the World Series? Start with you. It's not going to be the Yankees.
It is not going to be the Yankees, unfortunately. It was a tough night last night. You know, Dodgers just spend so much. It's tough to see anyone other than I think they're coming out of the NL for the Philly fans in the room, but the Dodgers are tough.
Good one. What do you think, Ryan?
I live in Oregon, so I guess the Mariners still have a chance, maybe.
They have a game
I don't know.
coming up. And another Yankee fan here.
I guess I got to go Dodgers.
Okay. And I'm also going to go to Dodgers. So let's go Dodgers, and we'll watch that game later today. And thank you, everybody. Thank you, the panel, Jeremy, Ryan, Nathaniel. Appreciate it.